I want to talk about something that quietly ruins more traders than bad strategies, bad entries, or bad market conditions. And this is an idea that really crystallized for me after studying the work of Mark Douglas and then living through it myself in real trading. Because for a long time, I believed the same myth that most traders believe that if I wanted to make more money, I needed to trade bigger, bigger size, bigger risk, bigger confidence, bigger wins. Small trades felt pointless. They felt like I was wasting my time. I thought if I truly believed in my strategy, I should be pressing it harder. And that belief nearly ended my trading career before I even realized what the real problem was. So here's the truth that most traders don't want to hear. Position size doesn't just control how much you make or lose, it controls your psychology. It controls how your brain functions under pressure. And once your position size crosses a certain threshold, your ability to think clearly starts to disappear. When I was trading too big, I wasn't trading the market anymore. I was trading my account balance. Every trade felt super important. Every little tick mattered. Every loss felt personal. And that's when discipline quietly fell apart. I remember staring at clean setups early in my career. The structure aligned, context made sense, everything was there. And instead of calmly executing my plan, I'd feel this pressure deep in my chest. My heart rate would rise, and I'd tell myself, this is the one, this trade needs to work. Not because the probabilities were better, not because the edge improved, but because emotionally I needed it to work. And that's where trading stops being a probability game and starts turning into a psychological struggle. And this is one of the most important lessons that Mark Douglas taught. The market is a probability environment. Your brain is not designed to operate calmly when too much is at stake. When position size is too large, your nervous system shifts into protection mode. You stop seeing the structure. You stop thinking in probabilities. You start thinking in hope that it won't hit your stop. You hope that the trade comes back. You hope that you're right. And hope is one of the most dangerous things you can bring into your trading. You see, when size is too big, everything becomes distorted. You hesitate on good trades, you move your stops because being wrong feels just unbearable. You take profits early because you're afraid to lose what you have. You hold losers longer because closing them would confirm the failure. And most traders label this as a discipline problem. They think they lack willpower. They think they need better mindset techniques. But the reality is much simpler and actually much harsher. Their size is too big for their nervous system. Discipline is not a personality trait. Discipline is a function of risk. So if the amount you're risking creates emotional overload, discipline becomes neurologically impossible. Your brain is doing exactly what it's designed to do. It's to protect you from perceived danger. The problem is that trading requires you to accept uncertainty and loss as a normal business expense. And when your size is too large, your brain just can't do that. Every loss feels like a threat, not just to your account, but to your personal identity. And once trading becomes personal, all of the objectivity, it just poof, it disappears. And this was the hardest part for me to accept. I had strategies that worked, I had rules, I had experience, but my equity curve looked like a heart monitor up, down, stress, relief, over and over again. I kept asking, what's wrong with my strategy? When the real question I should have been asking is, why does risk feel so overwhelming? And the moment I asked that question honestly, this is when everything started to change. So I did something that hurt my ego pretty badly at the time. I reduced my position size to a level that felt almost meaningless. Wins didn't excite me, the losses didn't hurt. It felt pretty boring. It felt like I was underperforming. And then something incredible happened. For the first time, I could follow my rules without effort. I could let the trades play out. I could take losses without emotional damage, and I could think clearly from one trade to the next. Nothing about the market changed. I changed. And this is the paradox that most traders will never understand. Trading smaller actually grows accounts faster than trading big because small size allows consistency, and consistency is what compounds over time. You see, big size creates volatility in your equity curve, and volatility destroys the compounding. So you don't build long-term trading income with just one heroic trade. You build it by surviving thousands of ordinary ones. When your risk is small enough that no single trade matters emotionally, this is where you gain freedom in your trading. You get freedom to execute, you get freedom to think in probabilities, and you get freedom to behave like a professional. You see, professional traders aren't fearless, they're just more structured. They don't try to control emotions after they appear, they control risk so the emotions don't interfere in the first place. So, trading small isn't a weakness, it's a psychological intelligence. Most traders don't blow up because their strategy or their system failed. They generally blow up because their position size was too large for their psychology. The market didn't break them, their risk management did. And once I accepted that, my entire relationship with trading changed. I stopped trying to feel so powerful. I stopped trying to prove something to myself and to others. I started trying to feel neutral. And neutrality is where the consistency lives. And this is another key idea that Mark Douglas emphasized. The goal in trading isn't confidence or excitement, it's emotional neutrality. The ability to treat every trade just as one event in a long series of probabilistic outcomes. When you trade too big, every trade becomes a judgment. It's a verdict on your intelligence, a referendum on your worth. And that emotional attachment, it destroys your execution. When you trade small enough, trades become just trades. Wins are information. The losses, also information, nothing more. And this is why professional traders focus on survival first and profit second. Many amateurs ask, how much can I make today? Professionals ask, how do I ensure I'm still trading next year? And that shift in thinking, I'm telling you right now, this will change everything. When survival is your priority, the desperation, it kind of disappears. And your desperation is the root of most trading mistakes. Trying to make money faster usually makes you lose it faster. Trying to protect your ability to trade allows money to come more naturally. The market does not reward the intensity, it rewards endurance. And endurance requires appropriate risk. Once you structure your size so that losses are tolerable and wins don't intoxicate you with euphoria, consistency becomes possible. And once consistency appears, compounding quietly starts working in the background. And that's how real trading careers are built. I had to unlearn the fantasy that success in trading comes from boldness. I had to detach from the ridiculousness I was consuming on social media. These massive home run trades and P&Ls that made me feel like that's what I was supposed to be doing. And it's almost a crime because success in trading does not come from that boldness. It comes from patience, repetition, and protecting your mental capital just as carefully as your financial capital. The unfortunate truth is that patience and repetition doesn't make clickable and exciting social media posts. Those big trades do. And once your mind is damaged in this way, it starts thinking this way, no strategy or system is going to help you. Trading smaller isn't about making less money. It's about staying in the game long enough for your edge to work, letting it pan out over time. This is why the trader who survives always outperforms the trader who swings for glory. And the moment I truly accepted that, everything changed. Not my system or my strategy, not the market, my relationship with risk. And that's when I stopped gambling and started trading like a professional trader. I really wish someone had told me this earlier because it would have saved me years of unnecessary stress. The market is not a test of courage. It is not a place where boldness is rewarded. It is a place where patience, restraint, and emotional stability are rewarded over time. Position size is the lever that controls all of that. And if your size is small enough, the losses become manageable, the wins become routine, and execution becomes repeatable. If your size is too big, nothing else matters. Not your strategy, not your experience, not your intelligence. It's almost a certainty that everything collapses underneath that emotional pressure. And once I truly understood that, and not just on an academic level, but I conceded to my innermost self, trading stopped feeling like a battle. It stopped feeling like something I had to win. It became a process I could execute calmly over and over again without needing the market to validate me. And that's when consistency finally appeared. And consistency is what creates real progress in this business. Not excitement, not intensity, not the big hero trades, just the ability to show up tomorrow with the same mindset you had the day before. Trading smaller didn't make me feel impressive. It made me feel effective. And effectiveness over time is what separates traders who survive versus the traders who ultimately disappear. So if there's one thing I hope you take away from this video, it's this. The market will always be uncertain, but your relationship with risk doesn't have to be. And when you get that right, everything else in your trading will have a chance to work. So manage your risk, traders, trade smaller than you think, and I'll see you in the next video.